Welcome everybody, OnTrack Wealth Management here. We're joining up at the beginning of May talking about market insights for Q2 2025. How you doing today, Jimmy?
Jeremy, I'm doing great. How are you?
Good. I'm glad to be done with April.
I am as well. Tax season's now behind.
There's a lot of good reasons to feel good about where we're at right now, especially compared to April. But yeah, I mean, generally, I'm in a good place.
Same here.
Right.
If the weather was a little bit nicer, it'd be even better, but no complaints.
Yeah, lots of rain. They say April showers brings May flowers, but in Michigan, I think it's a little bit later than that.
We're waiting for it.
Yeah. Okay, the portfolio points that we're going to touch on here today. This is going to be a pretty tight segment. We're not going to be as long, I don't think, as we normally are in these spaces, but we're going to cover a lot of ground. We're going to talk, of course, about tariffs.
Oh, are we?
Have you heard of those?
Have you heard of them?
We're going to talk about performance year to date and how that, what that portends for the future. And then some bright spots.
Sure. Sounds good.
So we're having a little fun here, right?
Yeah.
We all know, anybody who didn't sleep through the month of April knew that it was a pretty volatile time. In fact, historically,
yes.
So I felt like I aged a bit around the month. Hopefully not as bad as this guy did over this timeline. But April 2nd was Liberation Day. You remember that?
I do. Unfortunately, I do. It was quite the shock the way it was rolled out. Again, it's not that we didn't see this coming, right? I mean, if you paid attention at all to the election, this was very well discussed, openly talked about. But the rollout on Liberation Day, I think, caught the market and pretty much everybody that's been paying attention to it a little bit off guard.
I was watching live when they were doing the dog and pony show from the White House garden there.
Yep.
And it was really interesting because I felt like, when Trump was talking, I felt like, oh, they've got a program here. This is pretty interesting. Now, I didn't know enough about the exact tariff amounts and the percentages and so forth to really be an expert and have a mind around it.
Right.
But what was interesting is I was watching this on CNBC, and while you're watching the live screen of it taking place and them announcing these pretty historically large tariff increases, the after hours market was playing on the side, and once he started to reveal that, boy, did the market drop.
Yeah, absolutely.
Like a rock.
We do not hold ourselves out to be trade experts or economists by any stretch of the imagination. But it was clear to see that the market was not, we know, and we've talked about it for, whether the key is, the big theme is tariffs or it was inflation or whatever the major theme of the time period that we're talking about is, the market we know does not like uncertainty. And those boards that were brought out and presenting the actual numbers brought on a lot of uncertainty. And the market picked it up immediately and responded accordingly.
That just speaks to how fast the market moves and how forward-thinking the market can be, even though it is very reactionary. Let's not get ahead of ourselves. It's very reactionary. So what happened here? So April 2nd, Liberation Day, we got really old on April 7th, it felt like, because by April 7th, we had experienced the 3 worst days since Black Monday in the 1980s.
Right. That was wild, right? I mean, all you saw was red on the screen. Everything was just precipitous drop. The next day you open up, you look at the futures market, precipitous drop.
Yep.
You think, all right, which at the time it was a Thursday and Friday, so it was like, okay, Friday wasn't that unexpected because you get a lot of the hedge funds and big institutional money closing out positions to get into the weekend, so you can get some momentum selling in a Friday. I mean, it really is not that uncommon.
Right.
But then we open up Monday and it's another red across the board, and it was like, oh my goodness, it's a precipitous drop.
Here we go. So then we got a little bit of relief on April 9th is when they offered up the 90-day pause on the tariff deal.
Right. Which whether you think tariffs are good or not, this is not a political discussion here at all, but the pause makes sense, right? Like, these are complicated negotiations to go through with our major trading partners, and it's difficult to expect the market to be able to respond any other way when you have such a broad stroke brush that was, hitting like a hammer with a lot of these numbers. So the 90-day pause made a lot of sense to me. Let's take some time, let's regroup, and okay, we've established that we want to make some adjustments to our trading partners, but we're going to take some time before we actually implement these to do some hopefully good faith negotiations.
I agree wholeheartedly. They say the bond vigilantes had a little bit of an influence here.
Right.
And if we talk about what that means is that, sort of, I always think about the smoky dark room where the bond traders all live.
Right.
And these guys and gals were making some noise. And the bond market was doing some things that made Secretary Bessent very uncomfortable. They had an auction of new treasuries, and they were worried that perhaps some of the other sovereigns and wealth funds and some of the big institutional money out there weren't going to be buying treasuries because, hey, maybe that's not the place to retreat to for safety. Look, that was a problem, and that was an underlying theme there for perhaps what motivated them to pull the trigger on the 90-day pause.
Well, what was unprecedented about that from the market's response, right, was like watching the market come down, the stock market come down was not, it's completely unexpected. The fact that bond yields with the vigilantes were going up, again, inverse relationship between yields and prices, bond prices were coming down, and the U.S. dollar was also coming down.
Right.
And that is like the capital has to go somewhere. And when the markets are declining and the bond yields are going up and the price is coming down and the U.S. dollar is going up, those three things don't commonly happen in tandem. So very unprecedented. And then it leads into the treasury auctions, right? And so there was some real shock and awe of what is going on here.
Yes, no doubt about it. So then April 10th, we had a little bit of concern. The market did again.
Right.
It wasn't necessarily buying the 90-day pause idea.
Right.
So,
one day we did, right? We had one day that we really bought the value of the pause.
Yeah, I mean, we within here, and I can't remember the exact day, we could go back and see it, but there was 10% increases.
Yeah.
And there was massive volatility within days.
Right. I remember you and I were sitting here having lunch together talking through this. And we looked up at the TV and watched the markets, and I thought there was like a typo or something.
Yeah.
Because I made the point like, oh my gosh, what just happened? The market just went straight up.
100%.
I mean, it was like literally a 90-degree line straight up.
You don't see double-digit gains on benchmarks in a day.
Right.
It's just not normal.
No.
So and declines for that matter. Okay, then April 21st, we kind of retraced almost to new lows.
Yep.
And then guess what? By the end of it, April 30th, we were down on the S&P by a little over 1% for the month.
Right. What did we get, like 9 or 10 straight days of positive gains for the benchmarks?
Yes.
I mean, that's, unprecedented as well.
So, our DNA is a little corrupted at this point, but hopefully we haven't aged super bad. So, what does this all mean in the context of history? We're not going to go through, nor are we experts on all the tariff history, but this chart can show you a lot. It shows you going back, over 100 years, and you see that tariffs were at one point a really big portion of the way that the federal government was raising funds.
Right.
A lot of this was pre-income tax era.
Absolutely right. Absolutely.
So, and where we're slated to go, at least initially, was higher than any of the previous tariffs in the past.
Right.
There's some history here. The Smoot-Hawley Tariff Act of 1930 during the Great Depression. It didn't do good things for the economy. If there was a corollary, you don't want to use that one.
We certainly hope that we're not heading towards a Great Depression-like response to this. But, again, whether these are right or wrong, or, there's still so much, again, the key word, the buzzword is uncertainty over, are we going to negotiate and have deals and these things are going to come off very quickly? Or are these going to be at what level will they be a persistent new theme moving forward? Still very much up in the air, very unknown. So, we're going to sit back and wait and see. But, we don't need to go through and discuss every one of these different points in time, and the historical context back then is a lot different than it is now, and so
truly,
it's just important to see where was it and where are we at and how long is it going to persist for.
Correct. And maybe a go forward question is the age of globalization gone?
Yeah, I mean,
I have a hard time believing that in today's world.
Right, I agree with you.
You look at cars, even the Ford F-150 that you now are an owner of one. Only about 50% of those car parts are made in America.
Right.
I mean, and that's that feels like if there's any true American car, the Ford F-150, the best selling pickup truck.
Right.
Forever.
Yeah.
50% American made parts.
Right.
So it is what it is.
It is what it is. That's where we're at today.
So I was sitting in on a webinar from O'Shaughnessy Asset Management, and they have and their Canvas group, which is what we work with for direct indexing. They do a great job, and their economist, super smart. He says, listen, a lot of this is about China.
Yeah.
Let's get down to brass tacks. There's a lot of moving parts with all these other countries.
Right.
Canada's certainly been swept up in it, et cetera.
Yep.
But a lot of it comes down to China.
Yeah, of course. I think everybody kind of knows at the root of this is China.
No doubt.
And we are the two largest economies in the world, and we need to figure out a way to make things work. And whether tariffs are right, wrong, or indifferent is still to be determined. But this is all about trying to reshuffle or reset the deck with the second largest economy.
Yeah. So the timeline here shows all these movements, and I will summarize it and just say that, look, the U.S. kind of started the piss and match here.
Right.
Like we're gonna raise the tariffs, and then China does retaliatory, and so on and so on. And so they're somewhere in a stalemate piece right now.
Right.
They need to get together. I think everybody knows that. It's a matter of how you do so. Look, culturally, these are two very, very different societies.
Right.
So, how the Chinese go about it, how we go about it is very different. But at the end of the day, there's got to be some meeting of the minds. There's got to be a negotiation, and I think there will be.
I think it'd be terrible if there weren't.
Indeed. So I think this is a fact in the sense that what we're dealing with right now is the uncertainty associated with tariffs creates some uncertainty in the economy. So when we talk about the economy, you often talk about the U.S. GDP,
right?
Gross domestic product, and we track this. It's an indicator, it's a very important indicator. On the left-hand side of this screen, you can see in this straight red, not the dotted, but the straight is the actual GDP, and then the trend is the dotted.
Right.
Then we do a kind of a focused in look on it, and it's really saying, like, what if we have a shock to the system that breaks down the GDP? How does that affect the trend line in the future?
Right.
And I think you can kind of see from the chart or from the slide here, it really creates this spectrum of different outcomes that could be negative, could be positive. They tend to trend a little bit more negative.
Right. Yeah. This comes back to uncertainty, right? Which is, we got it on the slide here. If you've watched any financial media in the last quarter, you've seen uncertainty talked about all the time. But we have more uncertainty right now than what we've had in probably back till COVID, where you just don't know. We shut the economy down essentially to deal with the public health crisis we had. But this is a different set of circumstances. But again, we've got very similar dispersion in the ranges of potential outcomes that a number of them do skew to the negative, if not handled and adjusted quickly and sort of like surgically.
Yeah, sure, absolutely, I agree. And then you look at the other side of this slide here. The example is United Airlines. Airlines are good examples, good proxies for how the economy is shaping up and how it's affecting things.
Sure.
Because at the end of the day, businesses and individuals can stop taking flights pretty easily, and it affects their business right away.
Well, we know the consumer is always roughly 70% of the GDP, right? And if the consumer is not healthy, they're not taking trips. If they have a lot of uncertainty and fear about the future, it's likely one of the first things that they're going to pull back on would be, we're not going to take the trip that we were once set to do. And whether that's a personal vacation or that's business travel, it doesn't matter. But you look at this is United Airlines that we're looking at on the right hand portion of the slide here, and we're looking at the range of outcomes as with their guidance and the forward-looking prospects of the business is, well, under one set of circumstances, it could look like one set of potential outcomes, but if these tariffs stick around, here's another range of potential outcomes. And as the gray bar shows you, that the full range is massive. So it gets back to that key word of just uncertainty of how long are the tariffs going to stick around, at what level, and how does that impact the consumer?
And the thing I'd add to that is I read an article and it said that when it comes to something like the airlines, it is the tariffs for sure, but it's also other things like when DOGE is going into the government and slashing, different departments and budgets and so forth.
Yeah.
That had an immediate impact on the airlines.
Sure.
So that was one of those things that showed an initial shock. All of a sudden, federal employees were not taking flights any longer. Mm-hmm. So it's just interesting that there's a variety of things that are coalescing here to create some of this uncertainty.
Right.
So there, as we talked about, and it's not going to be all negative. There's going to be two sides of this coin.
Right.
Negative outcomes and possibly positive outcomes. When it comes to the negative outcomes, we really like this slide from BlackRock. It looks at something that could be a really good case study for us to figure out how this would affect the United States. And that case study is United Kingdom during their Brexit. If you can remember back, Britain was part of the European Union. They voted to jump out of it. It's a really big deal.
Completely caught the markets off guard.
Caught a lot of people off guard for sure. And in this chart, what you're seeing here is you're seeing the United States in red, European market in yellow, and UK separately in green. Great. They follow some similar trend lines. You can see the dip there in 2020 for COVID. Understood. But I think what we want to point out here is UK is significantly underperforming its peers in the U.S. and more importantly, probably the European Union.
And I think most people would view that as like they shot themselves in the foot, right? Because they voted to do that. It wasn't anything that was forced. That was their decision to implement policies to, hey, we're gonna leave.
Yep.
And we're gonna go negotiate our own thing, our own deals, and it didn't work out so well.
It in terms of capital investment, it has not been a good thing for them.
Right.
So the positive outcomes, you do have to thread a needle here.
Yes, definitely.
It's not an easy thing. And I've sat through some pretty smart webinars on the subject, and the Trump administration has its pillars that it's trying to build upon, right? They want to have tariffs to build revenue. They want to provide stimulus through tax cuts.
Yep.
And they want to deregulate, which they also think is stimulative.
Right.
Right. So they have a plan. It might be a little chaotic.
Right.
There is a plan. I'm not sitting here justifying. I'm just stating that and sometimes when it doesn't seem like there is an articulated plan, it's there.
Yeah.
It's just going to be a hard one to navigate.
Right, and it doesn't always play out in the media the way that you might expect.
Yeah.
Right. So, listen, there is a threading of the needle that needs to be done. I would say, in broad strokes here, that most economists, market followers, market participants don't disagree that there should be a reassessment of trade deals and are we being taken advantage of in certain circumstances? Are we taking advantage of others in other circumstances? And let's take a step back and figure this out through negotiation. How can we make this sort of better for everybody? But focusing on us here in the U.S., are we being taken advantage of? We mentioned China's the big one here. Is there a way that we can create better trade relations moving forward? That like this is maybe just potentially just a momentary step back in time that the market didn't respond well to, but there are very potential long-term benefits that come from it. Again, we'll see it. That's where the threading the needle of how long do these stick around and at what level and how much revenue are they producing and what is that revenue? If we do have tariff revenue, what is that being used to offset? I mean, are we getting tax cuts paid for by that? Mm-hmm. Is there, obviously we have a big debt. We have over $35 trillion of debt here. Is that revenue being paid, used to pay that down? So again, threading the needle.
Yep. It's going to take both of these things to happen in order for this to turn out positively for us. It's possible though. All right, we're switching gears. Let's look at things on a year-to-date basis. So we're going to go back to January 1st through when we ran this chart was the other day here at the beginning of May. This is the model portfolio. So for those of you who work with OnTrack and you know us a little bit, we're asset allocators.
Right.
We're always going to say to you the biggest and most important question that you can answer is going to be what percentage in stocks, what percentage in fixed income.
Absolutely.
So this is a great indicator of how those different portfolios look. It ranges all the way from 100% in equities to 100% in fixed income and all the variance in between.
Right.
So it's pretty tightly wound, right?
It really is. I mean, it's a tight range. You see a lot of crazy movement in there with the volatility. You can clearly see when the volatility really kicked in. But when we get to the end of April and beginning of May when we ran this, there's a very tight spread between the best performing benchmark and the worst performing benchmark year to date. Yeah. Now, again, some additional context to this is, so if we're looking at the top, we've got the all fixed income is the best returning benchmark year to date, which not that surprising. However, the exact inverse was true when we were running this last year, because the prior 2 years, the stock, particularly the U.S. stock market has done very well, and it's been the best performing assets or asset classes. So we've, and you shouldn't expect these trends to go on forever. So yes, there's a lot of this that's impacted by tariffs, most of it impacted by tariffs. But it shouldn't be that surprising if you were just to take a step back and you weren't focusing on the tariffs and you just looked at the price movements and seen 2 years of 20-ish plus % returns in the S&P 500 and the NASDAQ and the Dow. It's not that surprising that they should have some more volatility coming off of 2 years like that, and that you should see the fixed income maybe have its time in the sun where it's been lagging for the past 2 years. So some additional context to this, but yes, your fixed income's your 100% fixed income is at the top, and your 100% stocks are at the bottom here, but very tightly bound together.
Indeed. I mean, well said. And the thing is, there was a little bit of a shock to the system in the bond market, but it recovered. It's doing what it's supposed to do, which is give you those boring kind of coupon clipping returns.
And I think, again, to your point, even though we did have a little bit of a shock in the bond market, it obviously held up much better than the stocks. And I think one of my biggest takeaways from what has taken place this year is the importance of diversification. And getting back to what you said about who we are asset allocators. And we say the most important decision is what allocation do you choose to use to allocate your investments. In the last 2 years, it was kind of hard to justify diversification. Some of those investments that you had underperformed the U.S. stock market by such a great amount, and you're talking 2 years in a row. It starts with, why are we even holding these bonds?
Yeah.
Why are we holding these international stocks?
Right.
And it was like, I understand that they're not performing as well, but there's a time for them, and they will come into play. And diversification means always having to say you're sorry for something. Well, this year, the value of diversification, having a diversified portfolio, has really showed itself to be the reason why you allocate and diversify over multiple asset classes.
So agreed. It's so true, and it leads us into the next slide really nicely. So one of the bright points here is the international developed market. You have the MSCI EFA, and you got a couple different things going on in this chart. Purple is the level change. Yep. So when you look at international developed as a basket of companies and stocks, it's performed at 12% year to date.
Yeah.
Awesome. It's broken through a couple of different points. Talk us through that real quick.
Yeah, so this is what we consider to be technical analysis, which is just looking at the price. So this is, there's no thoughts about profit margins or sales growth or anything like that. This is just looking at the price of the index. And then what we're doing is the blue line represents the 50-day moving average of the index. So how has this index traded over the last 50 days, which helps remove some of the noise of the last
smooth it
weeks.
Out, right?
Moves it out.
Yeah.
And then the orange line represents the 200-day moving average, which is even more important because it's a longer period of time. So it's from a technical analysis perspective, technicians, as they're referred to, really like to see when a benchmark or a stock or some asset is trading above its 50 and 200-day moving average. That typically, in their line of thinking, is a way to show this is an investment that has more upward potential moving forward. When you get below the 50 and 200-day moving average, there's cause for concern. Now, as you see here, we broke down below with Liberation Day and the volatility that ensued after that. But after we sort of had that little bit of a breather, the international markets have done very well. And they've been boosted by, again, before I mentioned, the stock market was declining, bond yields were going up, bond prices came down, but the US dollar was also declining. And remember, the currency impact on international investments is when the dollar is weakening, that's very good for your international investments.
A great tailwind.
On a currency, right? It's like it almost functions like a kicker to the return.
Yeah.
So it doesn't necessarily mean that we've had 12% economic and sales and profit growth overseas. That's certainly a part of it, but there's also a part in there of the US dollar weakening that helps increase the return that would have been otherwise realized.
No doubt. Two things to point out as well. You literally have a V-shaped recovery here within a couple of weeks here.
Yeah.
The international market broke down just like everything else. But look at how it rebounded. I mean, that is wild to see that.
The velocity was very high there.
No doubt. So, and look, international, part of the attraction to the international market isn't just because people are all of a sudden tired of the U.S. and think the U.S. is going to be trash moving forward. That's not it. Part of it is the market started to look at valuations. And the valuations in these international markets are much more attractive than they were in the U.S.
That's a great point. And they also have much typically higher dividend yields.
Right.
So you start to get some steady, return of capital from the investments over there. Not as much tech investment over there. So those things, all those factors played into what we've seen. And again, it's just nice to have at this point, at least, this is why it's important to stay diversified.
Agreed. Emerging markets, a little different, but similar, really.
Yeah.
A similar story.
Right.
A different basket of countries and stocks as a result. Driven mostly by things like Brazil, India, China.
Right. And what countries are benefiting from the breakdowns in trade relations between different countries. When the money's got to go somewhere, and asset, the investment it's got to go somewhere. Otherwise, it's sitting in cash. And so certain countries are going to benefit from what's taking place. And again, I think this chart follows kind of what I would have expected. It's more volatile than the developed international markets, as you see in the line, the purple line pre-Liberation Day. But again, similar, you had quite the V-shaped recovery in the emerging markets as well.
No doubt. So again, asset allocation, which leads us to our next slide. We show this every single quarter.
We should.
Because it's so important.
Yeah.
This is the periodic returns of asset class returns. So highlighted, 2024, take a look at it here on the right-hand side, top to bottom, top being best performers, bottom being worst. It was what it was. We absolutely know how 2024 was. It was a great year. Now look, there's a lot of swapping.
Completely flipped, right?
It's a flip-flop, right? And this is what happened.
This is why you stay diversified. I mean, I said it before, but this chart illustrates it better than before. The top 2 asset classes in 2024 were U.S. large and small cap stocks. Look at what are the bottom 2 year to date. I mean, it's literally a complete reshuffling of the deck there.
Yep.
And the tough part about investing is that you just don't know when this is going to happen. I mean, if we knew, we would have moved a lot more money around for clients. You don't know, which is why you set an allocation. You create strategic long-term targets for your investment allocation based on a financial plan. You rebalance back towards those targets when asset classes move beyond or below their long-term thresholds. You rebalance back. That rebalancing is forcing you through a disciplined action to sell high and buy low, which is what you want to do in investments, right? You don't want to buy high and sell low. That's the opposite of what you want to do. And so diversification and rebalancing your portfolio, this is when the value of doing that really shows itself in a time like 2025.
No doubt. I mean, if you were to go back and reassess our quarterly insights videos for the last couple of years, you would have found about 2 years ago us talking about international.
Yeah.
Now, was our call early? In hindsight, way early.
Way early.
Right? But it was right.
Yeah.
There was going to be a shift. How sustainable that shift is, how long it lasts, we don't know. But we want to make sure you're allocated to these different sectors within the market.
Absolutely.
So we're certified financial planners at OnTrack Wealth Management. We always try to kind of circle back to this at this phase in our quarterly outlooks, our quarterly insights videos. Hey, you got to make a plan. You have to have a financial plan in order to make good decisions in terms of how you're going to allocate and how you're going to approach volatility, opportunity, etc.
Yeah, I think it's one of those things where I feel bad for the folks that don't have a plan put together for them in times like this. In 2023 and 2024, the stock market is doing nothing but going up. It's sort of easy to just look at your monthly statement and see the balance going up and not worry about a plan. But if you've got a plan built that you've accounted for volatility and the allocation that you've chosen, then it makes it a lot easier to get through these times of uncertainty and the sudden shocks to the market and the declines that we saw. It's a lot easier to live through those knowing that I've got a plan that has accounted for this. And so again, that's why we are just massive proponents of making a plan, doing so with a certified financial planner, so that you can have the confidence that you are allocated in a way that is sustainable for your long-term success.
Couldn't say it better, partner. So what does it all mean, right?
Yeah.
What does it all mean? Look, it is going to be a choppy time. So, if you've done yourself the favor of building a plan, setting an appropriate allocation for yourself, go ahead and enjoy spring.
Right.
We're turning into summer here soon enough.
Hopefully, right?
It will get warm. It will get consistently sunny. Go fishing. Go have some fun. Enjoy yourself. Go golf, right? Do the things that you want to do, and don't sit here and ruminate on the headlines. The market will take those all into account.
Right.
And we have faith that it's all going to work out in the long run.
Yes. So
that's our best philosophical advice.
I couldn't agree more. I'm looking forward to golfing, fishing, swimming, enjoying some nice weather.
Indeed. And we'll finish it on a fun note. I know that you've got a little hoarse voice.
Yeah.
What was it that brought that on?
Well, as you know, I've got the 3 little ones, and I was coaching my son's hockey tournament this past weekend, and it's the first year of playing full ice hockey. So I was doing an inordinate amount of yelling, trying to communicate to the players on our team of just how to get them to line up for a face-off, which is very basic and fundamental stuff, but the boys are just learning, but we had a great time. The team did very well, and it was a lot of fun. But yeah, it was difficult and tough on my voice.
Yeah, no doubt. What fun though! And just to give you guys the bookends out there, my son last night had his senior night for lacrosse. All the seniors were honored. Unfortunately, they didn't get a win, but but it was really fun. It was nice to see, and I think my kid, who's pretty stoic, was even like, he cracked a smile. So
yeah, that's awesome. That's great to hear.
So, well, that's all we have for the Q2, folks. Stick around for more videos that'll come your way throughout the quarter, and then of course we'll see you again in Q3.